With all the recent news about the stock market being down, you might be wondering what all this means. If you're a beginner and you want to understand what the stock market is and the basics about it, you're in the right place. I'm going to cover the stock market and how it works, so maybe you can have a better understanding and even start investing yourself. So let's get into it. So, to understand the stock market, you really need to go back in history. Way back in the 1600s, the Dutch East India Company was a trading company. They shipped goods all over the world. They traded in things like gold, porcelain, spices, silk, all sorts of things. And these voyages were really expensive for them to do. And so, in order to fund these, they turned to the citizens and they made it so that citizens could invest in the voyage. And then, in exchange for the investment, they would receive a share of the profits after the voyage. So, this practice allowed them to take bigger and better voyages and benefited them, and it also benefited the investors. People would sell these shares in coffee houses and at the ports and all over the place. And so the Dutch East India Company, without even knowing it, they invented the world's first stock market. So since then, companies have been collecting funds from willing investors, all right, to support all kinds of businesses. And today, the stock market is this huge, complex system. It has people working in it with schools, careers. There's TV channels dedicated to it. And I'm sure you've heard about it. It's all over the internet. There's all kinds of trading sites, and the internet's made it even more crazy. There's all kinds of markets today, regular stock markets, equity markets, share markets, where people sell stocks and trade stocks. And basically, this is how a lot of companies generate revenue for their business. So the simplest way to think about it is that when you buy a stock, you're getting a tiny portion of a company. So you're a partial owner of a company. Now, one stock, depending on the company, it could be a very small percentage. And it's called a share. All right. So companies sell these shares to get money to help them grow. Now, not all companies do this. Some companies are private and they don't sell shares to the public. They could sell them privately, but they might not. Private companies don't sell on a public market. So a public company, if they want to sell shares, they have to do something called an IPO, which is called an initial public offering. And this is how a private company goes public and raises, could be millions or even billions of dollars. And this funds things like hiring employees and buying goods or building infrastructure or equipment or whatever they need to expand their business. This is one way that they do it. So how does it work? How does the stock market work? So once a company has an IPO, their shares are traded on a secondary stock market. This is where the buying and selling happens. Most of this happens today on the internet with computers. It's super fast. You could go online right now and instantly buy a share of stock. And these computer systems match buyers and sellers that are willing to buy or sell at a certain price. So the majority of trading happens on a few major exchanges. So there's the New York Stock Exchange, which you've probably heard of. And that's a physical exchange they sell both electronic and they actually have a floor. You've probably seen a picture of all the people on the floor where you could physically trade stocks with people individually. And there's also the NASDAQ. But the NASDAQ is just electronic. There's not a physical floor. What makes a stock go up and down? So it all comes down to supply and demand. Okay. If a lot of people believe in the company and they believe that it's going to be a great company, it's profitable, and they want to buy the stock, then the demand for the stock increases. And that means that the price is going to increase. So more buyers means higher price. A lot of times a company will go public, like you have a company that's super popular now, like NVIDIA or Tesla, which Tesla's been down lately, but interest and a lot of publicity makes the stock price can go up very fast. And it boosts it, and even one stock like NVIDIA or Apple or Google, these big stocks, they can actually boost the entire market. They're so popular and they kind of all the other stocks. Now, also the reverse can happen. So if a company's not doing well or it's not making good profits, then it's on the decline. Then people will lose faith in the company and they might start to sell their stocks. And the more people sell, the price will start to go down. So, because there's less demand for the stock, so the stock will fall and so will the market value of the company. And this is a constant change. You've seen charts, I'm sure, up and down. It's a seesaw. Supply and demand, it's influenced by so many things, right? Mainly, it's going to be things related to the company itself or maybe the market that the company is in. And usually it has to do with their sales growth or their profit margins. Can happen like changes in leadership, prices of materials, sorts of things can affect the company and can affect people's confidence in how well the company is going to perform. So sometimes the events that happen might not even have anything to do with the company. So, like, think back to 9/11 or whatever, the market went down. And that didn't have anything to do with the particular company, but it just affected the overall market. So all prices went down as people took money out of the market. So lots of people selling. And you might have heard terms like a bull or a bear market. So bulls are people who are buying stocks and they feel confident, they think it's a good investment. So when you hear a bullish market, that means that it's going to be going up because people are buying. And a bear is the opposite. A bear is selling the market. So that means that they're not confident and they're selling it. So a bear market is going to be going down. So when you hear bull market, it's going up. When you hear bear market, it's going down. So to make sense of the overall market, investors usually look at what the index is doing. Okay, these market indexes. And these are sort of like, if it is like scorecard of like the overall market is going. The Dow Jones Industrial Average. Now that index tracks 30 large companies in the US. Then there's the S&P 500. You can probably guess how many companies that are at 500, right, of the largest companies. It tracks those and it's sort of a better indicator because it's more companies, right? It's more. And then you have the NASDAQ Composite Index, which is all the stocks on the NASDAQ. But also keep in mind that the NASDAQ is tech heavy. So a lot of tech stocks are in the NASDAQ. So those are some of the popular indexes that people watch and they can sort of figure out, is it a bull market or is it a bear market? Is it up or down? In order to get started, anyone can buy stocks. So if you have money, you can buy a stock. So typically people will open some sort of brokerage account. There's lots of, and I'm not going to get into specific ones. There's no ads in this video, but you can an account on a brokerage account and put some money in it and then buy a stock. It's just that simple. And then that brokerage is sort of housing or keeping track of your purchase. And then you can go back to that brokerage and sell the stock whenever you wanted to sell it. And that's pretty much as simple as it gets. And then as you buy or sell stocks, all of the stocks together. That some people refer to that as like portfolio. And basically, when you buy a stock, you really want to know something about the company. If you just buy a stock based off of news or whether you just think it will go up and down, that's really called speculation. You might have heard that term. And speculation is essentially gambling. You're just betting that it's going to go up. More savvy investors will learn about the company and know the fundamentals about the company. If you've ever listened to like Warren Buffett or read a lot of his books, he is more about learning about a company and knowing about its fundamentals. Is the company profitable? Is it a business that is going to keep growing? Is it a long term? He loves to invest in things like Johnson and Johnson, Coca-Cola, that are like they have a solid foundation. They're just going to keep making money. So even though the stock market may go up and down, because this company is so solid, he's confident that over time he's going to win because he's not really speculating. He's looked at the company and he knows the fundamentals. So if you're investing in a stock, I strongly recommend that you know about the company before you actually invest in it. Another option is to also invest in index funds where you actually purchase a stock that covers a wide range of companies and you're really just riding the index. So I have some videos about investing and saving. I'll link that. And that's another safer way to invest in the stock market. All right, so to recap it, we've kind of all of the basics. We learned that stock market is a marketplace where people buy and share public shares, and that's where they're bought and sold. They represent ownership. The prices fluctuate based off supply and demand. They can go up or down. And we learned about bear and bull markets, and we learned about, how you actually go about getting started in this. So I hope that this video was helpful in giving you sort of a basic understanding of the stock market, what it is and how it works. Obviously, there's a lot more to it. It can get super complicated, but these are the basics that you need to understand. And yeah, if you found this helpful, please like my video. I love it if you subscribe. If you want to hear more videos like this, I cover simple financial topics for people. And thanks again for watching, and we'll talk to you soon.